right, so we're going to be talking about the factors shaping tomorrow's markets, which really could take us anywhere. We could talk about tomorrow, we could talk about the medium term, the long term. As many of you know, I present a show on Bloomberg TV, and I would say most of the conversations I've had in the past month have been dominated by the three T's: Trump, trade, and tariff. When you talk about anything to do with 2025, I'd also add one extra dimension to that. AI is also the big theme as well. So with that, there's going to be a lot to talk about. Alex, I'm going to start with you. Given how broad your geographic remit is, how much of a feature is geopolitics and geopolitical considerations in terms of where you think the factors driving markets are going to come from?
So I would say that geopolitics is probably the most used buzzword these days. And what's important is the fact that, for many locations in the world, and I speak for Europe first and foremost, it's an untrained muscle, right? Up until very recently, we didn't care about geopolitics that much. Since the end of the Cold War, this factor has not been seen as a risk factor, really, and today it is, and we need to adapt and accommodate to that muscle very quickly. And across all markets, you see this factor obviously playing out. A, because it adds volatility. We know, not just because of the latest elections in the US, that additional tweets and additional messages can very quickly lead to market distortions that need to be taken into account. What that means is it leads to shortened investment horizons for those markets that are being seen as affected or potentially affected by geopolitical negative driving forces. It will consequently lead to an increase of investment tenors, and the size of capital inflows for those markets then can provide stability, and that are, let's say, sacrosanct over the question on how geopolitics do evolve, which, by the way, is something that I think this part of the world, this region, and the UAE in particular, very much benefit from, because both what I said in terms of knowing how to navigate in geopolitical difficulties is something this region is well trained in. B, it does provide a lot of stability, ultimately, safety, legal clarity, ability to operate globally, and be also pragmatic with respect to relationships to other nations.
Yeah. Raymond, maybe we can touch on the opportunities in EM, perhaps at another point in the conversation, but I also just want to ask you about another topic that we tend to talk about a lot, and the market reacted the day that Trump announced that Scott Bessent was going to be nominated for Treasury Secretary, namely because one of the things he said recently caught people's attention, and that he is focused on reducing the size of the US deficit, and it feels as though debt dynamics, the size of the US deficit, not just specific to the US, but around the world, people are concerned about French debt dynamics now, about UK, emerging markets, always a bug, not a feature. And I just wonder to what extent we're going to see all of these factors come together in 2025, if at all, or is it just something to think about on the back burner?
It's a very valid question, Jumana, and it's top of my mind. Probably top of my list of concerns when I think about debt sustainability at large. It's not just the headline level of debt. We know that the US is in a post-World War II high, around 120%, but that is also shared by many other Western so-called developed market economies as well. I've recently relocated to Geneva from London, and the memory of a Liz Truss moment is still fresh in my mind, and I think many of my fellow British colleagues in the room as well. But what was interesting about that moment is it wasn't catalyzed by a particular debt level. It was catalyzed by a crisis of confidence. And that's an intangible. That can happen at any moment, and it's very difficult to predict and to prepare for. When you have a stock of debt, and let's take the US, coming back to your example, where $8 trillion of debt needs to be refinanced in 2025 alone, that's 30% of the US Treasury stock, and that's without even accounting for new debt incurred. The chances of an auction which maybe doesn't go as according to plan, or one of these kinds of situations, I think cannot be ignored. And I think that becomes more than just a tail risk at this point in time. We've seen in Europe, for example, Greek yields trading at lower levels than French yields. Who would have once thought that possible?
Yeah, yeah. So something to think about for next year then.
Absolutely.
Okay. Kavir, let's take you to the buzzword that everyone wants to talk about all the time, and also the leadership in stock markets is coming from a handful of stocks. Let me just ask you, given your role as Chief Innovation Officer at BlackRock, artificial intelligence, you have a level of understanding that perhaps nobody in this room does have. Where are you still finding value these days in AI applications?
Value is found in different areas for everybody. It depends where are you interested in. The number one thing asking about people is around productivity, which this is something that it's work in progress. People are looking to find value into this whole chain, chip to AI, what I would call. And in the chip to AI story, I think UAE in particular is taking a leadership role where basically, investments in the area of infrastructure, they are very, very much on their mind. And, as much as we are right now into the training mode, so everybody wants to build models that they are 1 million times faster than we currently have, hoping that this way we'll get maybe to something like a GAI, where basically you're going to have an Einstein sitting behind you and giving you an answer to everything that you need and directing you accordingly. In that point, we might be more into the inference mode, which currently we're talking a little bit less about it. So that's another area of value. So you have value in the into the actual stack of building the AI. On the application level, it's productivity, and the secret sauce, it's coming out through the data that you actually have. So that's kind of what you're going to have to take out value from, and otherwise building the whole stack. I think these are the areas that I will kind of define as the areas of value.
Alex, bringing it back to the title of this panel, the factors shaping tomorrow's markets, do you get the sense that investors are chasing those companies that are making the most use of AI applications and are looking to gain the most productivity-wise out of them? Is that where the money is going right now?
I think from a capital market perspective, you see undoubtedly a lot of money going into the sphere, but not so much on organizations that are adapting and accommodating AI technology, rather those that are the source of new technology, which is still obviously more in the face of venture capital-esque kind of domain. The next chapter will indeed be who's making the most out of it, right? And so whilst we're still in this first chapter, as in previous cycles, I guess there will be, a lot of money will be burned. A lot of money will also end up with tremendous returns. But there will probably be, it's fair to say that short term there's probably a hype. Long term it's still underestimated in terms of what it can do. And the question on organizations, whether they will benefit from it or not, will very much be path dependent on the adaptability, the opportunity. You really build this into your process, you replace it. By the way, it's not just AI. I think AI is the next step. Many traditional organizations still can benefit from very rural automation and incubation of robotics before we talk about AI.
Yeah.
But in any case, there is meaningful upside. But it's key from a managerial standpoint and also from another angle, and that is demographics. Because we're all facing, by the way, that's all inflationary, the shortage of labor, regardless on what industry you're talking about. When you look at, Western nations in particular, the adaptability and the speed thereof will very much decide on how you do in terms of global competitiveness.
Yeah, but it is so important, a discussion, also in terms of market sentiment. And if you look at just the S&P this year, on track for 30% gains, but actually I read somewhere that about 20% of that, or maybe even more, is driven by one stock only, and that is NVIDIA. And so on a day where NVIDIA is down, it tends to have repercussions across the broader market because leadership has been so concentrated. When you think about the risk factors for next year, do you worry that perhaps the concentration of the market and the focus on the market on just a handful of stocks could be problematic?
I think the concentration of monies, if that is your point, probably not so much. I mean, we've talked about the Magnificent Seven and the like. We know that there are components where certainly a repricing will take place. I think the larger issue will be determined by the fact on how certain regions, locations, markets, and businesses really will evolve. We haven't really seen the end of the test on all the monetary stimulus that central banks have started to take out of the system. Yes, they're now reducing rates. They will probably not, in particular in the US, not reduce rates as much as the market was predicting up until lately. One of the reasons is that underlying inflation is still very sticky. And when you look at areas like commercial real estate, where those implications of higher interest are much bigger to the negative, here we have probably not seen the end of the pain. I would rather worry about those components and industries in general that are, victim to, we talked about geopolitics, but the frictions that we're seeing in supply chains, which have been initiated through the COVID aspects and are now riddling through, with more political noise, tariff threats and the like. The adaptability of some industries has not been accommodated for. This is probably where I would rather see the more imminent concern from a market point of view.
Yeah. Raymond, I want to go back to something that Alex said earlier about geopolitics, and that it actually may create opportunities for countries or jurisdictions that know how to navigate those geopolitics better. And I just wonder, from your standpoint, many years of investing across the world, whether you think emerging markets are better equipped to deal with what could come, assuming that Trump administration does come back, starts imposing higher tariffs, and we move back towards a more protectionist regime. Can EM assets still do well in that environment?
Not only can they, I think they actually will outperform, and I do think it's different this time. That's the perennial question we always get in emerging markets. Is it different this time, Jumana, right? And I truly believe it is, and here's why. The tariff dimension isn't new. It's a blunt tool which has been used in the past. It was used as recently as 2018 by Trump. It's interesting to look at what happened at that point in time. Actually, the impact on emerging markets was extremely muted. There was a more direct causal effect on China, but that very quickly diverted in terms of trade channels to the rest of Asia and to the rest of EM as well. I think that that's a very good precursor and a very good signal on what's likely to come. Now, of course, if we go from 10% to 60% in China, that can have an impact on China and Chinese GDP. And I think that's actually going to be a greater determinant on EM profiles and outcomes than ultimately the US. But really, at the end of the day, EM is in better shape than it was before. It's more independent and codependent. Let's take Asia as an example. In the broader emerging market sphere, 50% of their trade is done with each other. You go back 2 decades, and that number was 25%. So they're increasingly, with every passing year, delinking from a dependency on the US, and thereby the shock impact of a tariff. But what's more important is their codependency on each other. And Asia is a prime example of this, with all the regional blocs, including the RCEP most recently. So I'm very positive on that outcome. I think that will provide a strong uplift to growth. And ultimately, EM performs when their growth is better than developed market growth. And I think that the center stage is poised very well for that.
Interesting. I wonder, Kavir, whether AI also gets caught in the crosshairs of geopolitics, because you have certain countries imposing restrictions on chip exports because of concerns about the passage of data, et cetera. Do you think that is going to stymie the growth of various industries, companies in certain jurisdictions because of these various barriers that are going up?
I think indeed there is some kind of AI geo movements. There is the story of the data that you can use at the end of the day, besides going and scrapping the internet, when you need to go deeper into actually having, important data that is related to certain jurisdictions. So that's kind of an element of localization or globalization of AI. Then it's going to be the story indeed of manufacturing of hardware. It's very interesting. But I think in addition to that, you're going to see, certainly hyperscalers, they are the ones running this story right now. And the way that they are going to deploy this type of infrastructure is going to be very much dependent on where this power is going to be available for such kind of environments. If you're looking into the largest data centers today in the world, even that hyperscalers are developing are in the range of, I don't know, up to say 200 megawatts. And when you're looking into what was discussed as relating to the requirements for facilities for these next generations of AI, we're talking about a couple of gigawatts, and I think the highest number was mentioned, to the President of the United States. It was something like 9 gigawatt of power. Well, these are very significant amounts of infrastructure that, together with the element of, the chips deployment, together with the element of data that I mentioned before, creates kind of a very special type of mix of what is the art of possible into these kind of things. But there is no running away. I think if you're looking into the next 5 years, currently the companies that they jump on this story of AI are about 14% are high growth companies with AI embedded in. In the next 5 years, this will be something like 64% market. And to Alex's point, in addition to AI, it's going to be robotics there. There's going to be all kinds of areas of, in the areas of health and all kinds of other things that they are going to shape the future global market, if you want, and the companies that they are going to be relevant in 2030.
Yeah, we've got a couple of minutes, but I want to ask a few more to Alex and Ray. Alex, Europe, it seems to be stuck in a bad place in terms of growth. At the same time, valuations are getting cheaper and cheaper. Could this actually be a year where Europe starts to outperform because the valuation play is there? Or is it that because growth and growth dynamics, growth productivity, all of that looks low, people are just going to stay away?
Europe has to, is the short answer, undoubtedly. I think there's a rising understanding on a European level. The recent frictions and instability you've seen with respect to governments, Germany, France, are to a large extent also driven by the economic situation. Unfortunately, it's a bit complex and not as speedy as one would hope, but Europe will get its act together at the end of the day. There will be very soon a more pro-business reform agenda, which is undoubtedly required, because when you look at the growth differentials between Europe and other locations around the world, including the US, then undoubtedly Europe needs to really step up. Again, it will take time, but the willingness is rising, and the pressure points are also mounting, because entrepreneurs, economic decision makers are crystal clear. Otherwise, we know what's happening. Capital will flow to other locations where growth opportunities can be monetized.
Yeah, Raymond, 30 seconds only.
I'm afraid we're going to have to stop it there.
Yeah.
I'm so sorry, but
Okay,
we're
well,
really
our time-
running out of time, and the
All right.
music will drown you
enough.
out. It's a big
Okay, thank you,
apologies.
panelists. Thank you.